Welcome back to the Beyond Wealth Advisors Economic Update. I'm John Cleaver, CEO and Private Wealth Advisor, and with me today is JC Ganote, Financial Advisor. Welcome, JC.
Thanks, John. It's great to be here.
It's great to have you. Well, today we're breaking down the earnings season from the second quarter of this year, and the headline is, corporate America proved resilient again, but the details show while it matters to be selective, even more selective than ever.
Yeah, that's very true, John. Since April, the S&P 500 is up more than 30% from that low we saw, with 8 of the 11 sectors in positive territory year to date. A lot of that has been fueled by better than expected earnings all the way around and lighter tariffs than feared. And corporate America is showing its muscle, I think, too, John, when you look at that. Hey, let's dig into the details just a little bit more, John.
Yeah, earnings has really proven to be the backbone of
it
this. So broadly speaking, most companies have reported 81% of the companies beat their earnings estimates. That's the most since 2021. And those beats weren't small either. Their average, over 8.2% positive, is the strongest since early in 2024. So that puts the S&P on pace for a 12% year-over-year earnings growth, making it 3 straight quarters of double-digit growth. Communication services is leading the way at plus 49%.
Wow.
Tech plus 21%.
That's a lot.
Financials plus 12%. So just growth everywhere. But today we're going to break down 10 takeaways from the earnings seasons beyond those headline numbers. And to get started, JC, what really stood out to you or is standing out to you beyond just the numbers?
Well, first, the CEO tone has improved dramatically. Mentions of recessions have dropped a lot to their lowest actually since 2007, and inflation references were cut in half from last quarter. Secondly, the consumer story is mixed. Overall spending is solid, but it's uneven. People are prioritizing experiences like travel over goods, and discounters like Walmart and TJ Maxx are outperforming while big box retailers are still lagging a bit. Bottom line, consumers are still spending, just more carefully. But what about the sectors really driving this market, like tech? What do you think about that, John?
It's a tech story, man. It's
been
been a tech story for a while. Mega cap tech, the Mag 7, continue to dominate. They've posted 27% earnings growth compared to just 7% for the rest of the index. 10 straight quarters of outperformance. And, we talked about AI a little bit last month. That boom is spilling over into industrials, utilities. Data center growth is driving the fastest U.S. power demand increase in 2 decades.
That's a lot.
Utilities are boosting CapEx nearly 20% this year, and suppliers just continue to benefit. It's really, really remarkable. AI isn't just reshaping software and chips. It's really reshaping our energy grid. But with profits flowing, how are companies going to spend all that cash?
It's a great question, John. That brings us to shareholder returns. Buybacks have stayed above $200 billion for 7 straight quarters, with full-year totals on pace to top $1 trillion for the first time ever. That is a lot.
That's unbelievable.
Dividends are also at record highs, with 10 of the 11 sectors showing growth in those dividends. But tariffs are the other side of the story. They're squeezing margins. Consumer staples have now seen 4 straight quarters of margin contraction. Big players like Amazon and Procter & Gamble are raising prices, while smaller firms, from beer makers to medical device companies, are facing higher costs that are harder to absorb. So on the one hand, companies are rewarding shareholders, but on the other hand, tariffs are pinching profits some. How about global factors like the dollar and commodities? They also have some consideration to be.
I was hoping you wouldn't say the word tariff today.
Right.
We couldn't get out of there.
We
can't get away from it. So the weaker dollar has been a boost for sure, down 8.5% year over year, the steepest drop since 2018. That's really helped those multinational companies, Netflix, Johnson & Johnson, Pfizer. But commodity sectors have lagged. Earnings, energy earnings are off 20%. And that sluggish demand has really kept prices subdued despite the weaker dollar. So this split really kind of highlights the need for being selective. So we've talked about how the market treated winners versus losers this quarter.
Companies that beat estimates were rewarded with stocks outperforming by about 1% the next day. But misses, on the other hand, were punished harshly. Those stocks that missed underperformed by 5.3% on average, the most severe reaction since at least 2017. And forward estimates, S&P 500 EPS for 2025 is ticked up to about $266 a share, the highest since April. But that strength comes almost entirely from tech. With tariffs rolling through in the second half, we could expect a downward revision to the rest of the year. So the bar is higher, the cushion is thinner, and the risks are really still real with the tariff story out there.
There just seems to be headwinds enough places. So, corporate profitability has been impressive, but those valuations are definitely stretched. 94th percentile historically, and sentiment is running hot. So what's the big takeaway? Resilience is here, but so are the risks. Mega cap tech and AI-linked industries remain strong. Tariff-sensitive companies and commodity companies face headwinds.
For investors, that means discipline and selectivity are still critical. Expect pullbacks, especially in high flyers. We've seen that several times this year. But remember, $2 trillion in cash on the corporate balance sheets supports dividends and continued buybacks as tailwinds in this market for the next number of quarters to come.
Yeah. So, JC, that was a lot. Those 10 takeaways, earnings season's almost behind us. Maybe just in your own experience and kind of your own understanding of this information, how would you kind of summarize what's going on?
The market always has something to worry about, does it not?
Yeah, that's so true.
There's always a wall of worry to climb, whether it's interest rates, whether it's tariffs, whether it's wars, no matter what it is. But right now, overall, I think this is going to shape up to be a good year. I mean, we've seen some rebound in the market. There's some interest rates cuts probably coming on the horizon. We'll talk about that in future.
Probably next month.
Right, exactly. They're right around the corner. So with all that said, I think it's going to continue to support a better stock market going forward.
Yeah, that's fantastic. Well, as always, we appreciate you tuning in and joining us. And we'll see you next time on the Beyond Wealth Advisors Economic Update.
Thank you, John. Appreciate it.
Thank you.